अस्सलाम वालेकुम सर।
वालेकुम अस्सलाम। जी कैसे हैं आप लोग?
सर बिल्कुल ठीक, आप कैसे हैं?
अल्हम्दुलिल्लाह। Quickly हम start discussing about this capital budgeting process, so that we can cover some other important context. So I'm just waiting the students to join. Sensitivity to variation assumptions, that is the topic we are going to focus now. कहाँ रहेगी बाकी कौन? So should we start or we should wait?
सर 2 मिनट तक और वेट कर लेते हैं, मे बी अभी आ जाए।
You are getting these lectures, recorded lectures? जी हसनात।
सर आपने ईमेल कर रहे हैं?
No, WhatsApp पे I have shared the link.
सर मैंने चेक नहीं किए।
Because I just want to, now I have made them public because some of the students in other class are facing the problem to open it. So for a time being, these are public. So once the time is over, mean after next week, I will make them again private.
यस सर, ओपन तो हो रहे हैं वैसे, जो यूट्यूब में है ना?
Exactly.
यस वो ओपन हो रहे हैं।
More students have joined, so okay, I'm just going to start because we have to save our time as well. So first of all, I'm just going to Recording is started. Once you are joining, you are getting the message. Recording is started.
Yes, sir.
Okay, it's mean recording is going on, right? Okay, that's great. Now we will focus on first of all. Previously, you already know about how to prepare this capital budgeting report, right? In which you have calculated the NPV. Now you are going to calculate this IRR and modified IRR, then this break-even point. So first we are going to do that, and then you are going to change the values, and you are observing how things are going to affect all these, how these changes are going to affect the outcomes. So first I'm just removing this feeling. Screen is visible to you?
Yes, sir.
Okay. This IRR can be obtained directly through the formula, right? And now we are going to use these values, and we are again picking these values uh, the same way. Just we have to make this one fixed, because otherwise it will scroll down. So both option you can exactly fix the only this particular column, or you can fix the only cell, right? So double this dollar sign, if it appears twice, then it shows that cell is fixed. Okay, there no need for guess. You can make your own guess, but there's no problem. If you are not going to make any guess, there's no problem, right? uh, so your discount rate is initially negative, the internal rate of return, but it is becoming positive, and in third year it becomes positive, right? And then further it start engaging more. So internal rate of return, just like I have previously mentioned, that is this is that rate of return which is equating discounted benefits to discounted cost. I mean, discounted benefit and cost both are equal to each other, and so net present value of your cash flow will be equal to zero. So actually, what it shows that how much capacity your business investment or project may have to generate some returns. So this business shows in the first year, due to the high cost and low returns, this rate is negative and very high, and then start decreasing in negative term, and then it become positive and then start increasing. Actually, what it shows that whenever you are going to take loan to finance this project, if you are going to complete this project in 5 years, or for the whole 5 years, if your project will continue, you may finance this project through taking loan if and market rate of interest is 10%, 12%, 15%, and so on, right? Because your capacity, your project has the capacity to generate 23% internal rate of return. So, but if your project is going to be winded up within 2-3 years, then it's not viable to take loan to finance this project, right? So it's better that you try to sell the shares and generate more investment through the ownership, selling ownership, or you may increase the scope of partnership and so on. Secondly, modified MIRR. I have just mentioned that this modified internal rate of return actually considered your discount rate as well as your reinvestment rate. So these are the two values which you have to consider whenever you are calculating modified internal rate of return. So modified internal rate of return is just different from simple internal rate of return on the basis of this reinvestment rate. Let's suppose if you are not considering reinvestment, then you are calculating the internal rate of return. But if you are considering reinvestment, then internal rate of return is going to change. So that is called modified, because now it is simple to understand. Every year business or corporate sector is generating profit, let's suppose, and they have to pay the dividends, the profit share to the stakeholders or to the stockholders or shareholders. Let's suppose they are increasing their retained earning. They are not going to distribute this dividend among common shareholders, retain this earning and reinvest it. So that is reinvestment, and that is going to generate more profit. Why that is done? Previously, we have discussed that because sometimes firms is going to expand, need more finances and funds. Sometimes they are in crisis, so they need funds to just move out of the crisis and so on. So instead of taking loans, they will prefer to do reinvestment or retain their earnings. So first of all, you will go for the values again. So this value and this value, and make this value again F4, right? Fix. Then comma, you go for finance rate. This is the discount rate, which is called finance rate. And then you go for reinvestment rate, right? And then be careful about that, because usually I'm by myself doing sometime this error, not making it fixed, but it must be fixed. This one as well as this one. So just click and then make it F4. It will be fixed, right? So both of the cells must be fixed beforehand if you want to get the correct answer. Otherwise, answers may be wrong. Since first year there is no reinvestment, therefore you will get the same internal rate of return. There is no variation, but first year some reinvestment is going to generate more returns, then in next year more returns, and so on. So this means whenever your reinvestment is going on, then the returns are going to be changed, and you can consider that this modified internal rate of return is even reducing some rate of return without reinvestment you are going to have, because definitely in that case you have to pay your dividends, the greater proportion of your dividends towards liability. That is just like more retained earning means you have to pay more to the shareholders. Okay, in case of break even point, I will prefer you to copy the formula. You can go through this formula. I just show you, just like I'm going to copy it. I'm not going to copy from this. It's 18 number, row number 18. So keep one thing in your mind whenever you are making some copy of this formula. So you have to be considerate about the number of rows and columns you are using. This shows the 18th row. So this formula will work effectively. If you are going to copy from this where it shows 20th row, then there would be some problem in the formula, because I'm just going to show how. So I'm just going to copy it first, copy, and then I'm going to put it here, only formula, right? So this value is generated, and this is even highlighted, right? So now I'm just going to click this. Now this value, because this formula is using this NPV value, and still it has some problem, but I'm just going to show this. This formula is using NPV and the time period, right? So it is going to decide in how many time period you are going to get this break-even point. So what is the way to get break-even point? When NPW is equal to 0. So when it is becoming 0, NPV, in this year or in this year? Please. In third year or fourth year, your NPV?
Sir, fourth year में.
exactly, not exactly in third year because still it is negative, but in fourth year it becomes positive, equal to 0, and then increased, and it comes to 7,708. It means in the beginning of this fourth year, it comes equal to 0. So this is going to be represented by this. After 3 years, with 62% of this time, and just like after 8th month, your NPV will be 0. So you are going to, it is just like payback period. You recover your R cost of production, so you come reach to the break-even point. So actually this shows this 3.619 is the exact time period. Okay, I just want to show this thing. You have to make some correction here because this time period is blank. You need not to use this one. So what you need to do, this H and G15 is not required. So you will stop up to this G15 and the F15 here, right? Clear? Getting my point? Enter. Some brackets are need to be reduced or changed, so it has done this. Now you will observe that the values are properly used, right? And they are incorporated because there is no value in the end, so you may not use it. Otherwise, if let's suppose you are taking some summations or some other value here, then it is creating confusion. So some readjustment is required. So same, if you are going to copy a formula from some other sheet where row number is different, then what will happen whenever you click this or copy this, some other rows will be selected. So the wrong rows will be selected in that case. Just like I'm just going to do that for your convenience, for your understanding, just like copy. And if I'm going to apply here formula, right? Then you may observe your results are wrong, right? Why? Because it has selected this row correctly, but this row is wrong, right? It should be this one. So keep this point in your mind that it is important whenever you are picking the formula. So I'm just going to revert it back. Clear? So anything which is creating problem here till here, if you have, now I'm going to move towards sensitivity analysis. Please quickly, if you have any query, problem, how it has been calculated, all these values you can calculate now.
Yes, sir.
Okay. Sensitivity analysis. Now we are moving towards this sensitivity analysis, right? What this sensitivity analysis shows, change in cash flows. Now it is possible that cash flows may change. If it increases, is it better or decreases? If it increases, is it creating problem or decreases then creating problem?
सर अगर डिक्रीज होगा फिर प्रॉब्लम होगी.
Because if it is increasing, then you are not worrying about it. You let it allow that it should be increased because you are always welcoming a rise in the cash flow. So cash flow, decrease in cash flow is problematic sometimes. Okay. Another problem, change in time. It may be start time, start of your project, or end of your project. It may be started delay with delay, or it may be completed with delay, right? So delay may appear. Right? Some delay is going to happen either in completion or in start. Then change in taxes, any other factor, tax, interest rate, or else any other kind of thing is going to change, and this is going to affect your business, right? Mainly in taxes, interest rate, or so on. Just like else mean, sometimes your shares prices and stock prices are going to change, and some other factors are going to affect. So all these changes need to be incorporated here. So first of all, what I'm going to do, I'm going to generate insert. Oh, no, it should be after here. Insert, right? Now I have inserted this row. Why? I'm just going to introduce change in cash flows, right? So this, what kind of change in cash flow is going to happen? It is going to be mentioned here. Let's suppose this change shows rise in cost, right? Let's suppose cost has increased up to, total cost stream has been increased up to 20%. 20% rise in cost. If cost is going to rise 20%, what it means? This value should be in percentage. So I'm just going to use the percentage sign here so that, sorry, 100%, 20%. Okay, which thing will need to be changed? Which thing need to be changed? This cost, right? Both, because this is the cash flow. So either cash flows are going to reduce if your variable cost is going to change, then cash flows are going to reduce. If your keep one thing, if your variable cost is going to change, then definitely its impact will be appeared here. Your stream of cash flow is going to disturb. If this is fixed cost, your fixed cost, installation cost, your rent has been changed and you have to pay, or your utility bills regularly you're paying has been increased, then this goes here. Actually, utility bills are just a part of your stream, so variable cost. Rent is by itself, but usually you can say whenever you are making payment for the buying the land, then you are going to spend on fixed asset, right? So usually it is 20% change in variable cost. Right? So I'm just going to incorporate this variable cost. So whenever 20% change is going to happen, it is negative value. Clear? So if I may mention minus 0.2, right? It is 20%. So it's not going to be used percentage sign. Minus 20%, right? So it has incorporated by itself. Minus 0.2 mean 20%. I'm just going to make it right. You know that it is going to affect negatively the project. So how it should affect this before tax cash flows? Here you have used this cash flows directly. Now what you will do, you will multiply with this 20%, right? And then you will do what? You will add original cash flow, right? So every cash flow is going to be multiplied with that, and plus the same cash flow need to be added, right? Then you will get this cash flow which is going to be changed. So I'm just going to scroll down, but okay, before scrolling down, it need to be fixed. This one need to be fixed. So F4. Now it can be done. So in all these things, what happens? 20% cash flows has been decreased. So this shows every time period cash flows has been decreased up to 20%. And all other things you need not change. Automatically they are changed and updated. So annual depreciation remains same. Your taxable income has changed. Your tax remains same, but after tax amount has been changed, and then your cash flows NPVs has changed. Previously you are capable to get your break even point after 3 years, and in the fourth year now you have lost that, and it comes to 4.85, so much. It is nearby end of the fifth year. So this project is highly sensitive now, highly vulnerable now, because it comes at margin, because now this project is not so much profitable, and you observe by yourself the IRR, the modified IRR, they become so low. Now 15 and 14% mean already you market interest rate is 12% or 13%. It means this is at margin. Now a bit any kind of smaller problem is going to make this project non-profitable. Clear? This point is clear to everyone?
Yes, sir.
Okay. I'm just giving you the hint about, first of all, how these changes are going to incorporate it, and then we will apply these changes to generate full stream of values, right? So this is one option. Cash flows has been changed, and then we are going to play all these scenarios one by one and generate over values. Secondly, let's suppose if this is not going to change, we are going to move back, right, to the original level. It remains same. Only tax has been increased. So tax is mentioned here 40%, and now tax has increased from 0.40% to 50%, 10 percentage point rise in the taxes. Now again entering, you will get the whole scenario directly, what has happened with output. Again, break-even point has changed. Again, internal rate of return, modified rate of return has changed. Your NPV stream has changed. So all these impacts are there because now the tax deduction amount has been changed, right? Whenever you are going to change this, now again, this project become again more sensitive because it is going to, this project or business or investment becomes reach to the break even after fourth year, not end of the 4th year, but beginning of the 4th year. So this means this problem, the rise in tax, is not so much problematic compared to loss of cash flows up to 20% or rising cost of 20%, but still it is creating problem. So here we are going to come back original value. Then if let's suppose your discount rate is going to increase from 14% to 16%, right? What will happen? It has marginal effect. It is not going to create huge impact, just like taxes has caused, just like cash flows has caused, because discount rate has changed marginally, reinvestment rate has remained same, right? So things has been changed. Now previously 3.6 was the break-even time, but now it is 3.8. So just like few months increased before arriving the break-even point. If your reinvestment rate has been increased, let's suppose increase mean let's suppose 17%, then your only thing is going to change is your modified internal rate of return. All other things remain same, but modified internal rate of return is going to be changed. Since this has increased, reinvestment rate has increased, it is the return profit over the reinvestment. So you will get more modified internal rate of return, value increased and improved. If it decreased, let's suppose previously it is 14%, now it comes to the 11%. And what will happen? This modified internal rate of return is going to decrease a lot. So this means actually reinvestment rate is playing important role. And usually it happens that people allow reinvestment if rate is high, if it is low, they don't like. Just like 60% is the discount rate, they can get 16% by making savings or depositing money with the banking system, and the company is giving 11%, so they are not enjoying this situation. they demand that their dividends should be paid back so that they can place it with the banking system to earn 16% rate of return. Let's suppose this is the discount rate for the market rate of interest. Okay, this is the change in tax and change in interest rate. So I have make this thing and I am going to do it third position. So I'm just going to place it following the sequence, right? Okay, now come to the delay. What will happen if, let's suppose, your project is not going to start on this time period, right? It is going to start a bit late, and in that case, let's suppose what will happen. Usually, whenever you are starting your project from this time period, you start doing investment. So in the first period, investment is going to make, and then some of the returns are going to be generated. So you are receiving your cash flows, right? So if it is going to start with delay, the cash flows are not available. Let's suppose you have make investment, just like I used to give this example in my 402 course, this Kalabag Dams project, that it had a lot of investment has been made. So a lot of cost has been spent, mainly the fixed cost on the project, but project could not start generating any kind of outcome. So the delay has caused a lot of losses. So the same thing applies. So what is going to happen? Let's suppose you have this before cash flow is going to not start from this time period. It is going to start from this time period. So these are the cash flows, and let's suppose I'm just going to make this it's not going to start from this time period, so make it 0, simple, make it 0 in this time period, and then we are going to use, because the same values should come but with delay. So first value this one, and then your value is going to be this one, right? Enter. Then your project is going to move ahead, and if it is going to continue for this time period, right, then you have to extract all these, move all these. Now you observe that the project is not viable in 5 year, because started in this time period. So I'm just going to move ahead so that we can have some values. So in actually it happens in the 6th year, because now project is going to be winded up in the 6th year because of delay. So first year nothing was received because project could not initiate it. Initial investment has been made in the base year, but project actually start executing after one delay of 1 year. It is just like you have established a factory, you have installed all machines and other things, and you are expecting that this has been done in 2020, and you are going to start producing 2021, mean after completion of this investment, and then you start producing, and your product is coming into the market in 2021 and sold. So you are going to generate some return in 2021. But what happens? You either start producing product but still not throw into the market. So these are placed with the in a storage, or only inventories are piled up, and you are not selling anything. So you are not going to receive any kind of cash and benefits. This is the one scenario. Another scenario, still your factory is okay, it is ready to start, but you are still waiting for some reason, just like you are try to get from some NOC or something else. And specifically, it happens whenever you are exporting your product to the other countries of the world, because in that case you need to fulfill different requirements domestically and internationally. So all these requirements are going to be met. Then you are going to place your order, and then your order is going to be delivered in another country, and then you are going to get back to cash. Let's suppose due to some political reasons, some other reasons, you cannot sell your product to the rest of the world. So both options are, in that case, inventories are piled up. So you have the option to sell in the domestic market, but you are not selling because you don't want to earn low profit, or you don't want to load down your prices of product because already competition is going on. But your product is designed for international market, so you want to sell it to foreign market, but still you don't have any NOC or whatsoever situation in which you can throw this into the foreign market. So that is just showing that kind of thing. But since the total time or life of the project is, let's suppose, 5 years, it will continue to 5 years, just like you got some kind of contract with the international business to supply the product up to 5 years without any problem, and then you have to sort out new market or you have to revise your contract. The same thing applies. Therefore, this will continue up to 6 years because it has actually started in second year. So first, second, third, and fourth, and fifth. So say fifth years values are coming in the sixth year. This is clear to everyone? The other, is it clear? Ibrahim? Okay.
Yes, sir.
Okay. Right. So now you will observe this, why it shows failed, because these values are not going to be incorporated in this formula. Therefore, the previous values which were incorporated and I have changed, I'm just going to replace that again. I'm just going to copy this because it has already incorporated that thing. So just like I'm going to copy this formula, and now it is functional, but it is giving the wrong value. Why it is giving the wrong value? Because it's not considering the time period, it's considering this value, because I have created another row. So keep this point in your mind whenever you are going to change your rows and columns. Then you have to be considerate about the formulas whatever you are applying, right? Because in that case the problem arises. So I actually, for this purpose, I have created the other data sheets in which it shows 20, because here this sheet is there, this column row is there already created, so it shows against 20. So it means we have to check first, and then is there any additional row? There is no additional row, only these two rows are actually, this row increase project benefit has been there. So it comes across 20, and what is the situation in our case? It comes across 90, right? It means one more row is there in this original data: taxable income, annual depreciation, before tax, year and benefits, income tax rate, life salvage value, and after tax modifier break-even points. Sorry, I have to come at 20th. Here something is there. Just going to use this. Okay, 1, 2, 3, life in the years, and income tax is 40% a year, and year benefit, and this. Okay. Actually, here this extra column has been generated now, just to copy the values after change, and then they are going to be incorporated into the before tax element, right? Therefore, if we want to apply this formula, we have to create one more row. Even we are not going to use that row as such, but still we need to create that before tax this here, just like if I'm going to insert this one. So now we can copy this formula and it will be functional, right? Okay, just like where okay, I'm using this row, therefore the problem is coming. I understand this situation. I can copy here this formula. Again, it is showing failed. Why? It's considering this one, but it's considering not complete values, right? So because rows and columns are different in this case, some values are oh, okay. because we have actually applied different change here now, and that is not considered in that case. This situation. I'm just going to revert that situation back so that we can apply this situation and we can observe what is going on with this formula, right? Initially, we can copy this formula here. I hope it may function. First, I need to copy it. It's working here now, because here it is going to capture all the values